Hi everyone. I will take you through our 2021 results and 2022 guidance. Now we usually come out with our results earlier in the month, but this year we had built a little bit of cushion in the calendar just in case there would be hiccups as we went live with our new SAP SAP S/4HANA platform. Now this system and all the related processes sit at the very core of the organization. And after 2 years of preparation and implementation, pleased to say, it all went smoothly. So an important competitive advantage as we transition into a digital company. Now 2021 was of course a year of strong recovery in commodity prices, with Brent increasing from about 50 in early January to 80 at year end. Now in between we saw extreme volatility in natural gas prices with material impacts on balance sheets across the industry. Wholesale power prices also saw a meaningful increase in most of Europe, supported by high gas prices and CO2 costs. 2021 Ebitda. So for the group, 2.3 billion, that's up almost 50% from the year before. And this was driven by upstream Ebitda of about 2 billion. Now in Q4 alone, upstream Ebitda was almost 600 million. Commercial Ebitda was 288, just under our guidance of 300 million. Now volumes recovered during the year, but we were still significantly below 2019 levels. Iberia has a very large tourism sector, so COVID had a bigger impact on the economies here compared with other regions. So now we're hopeful that this will improve quickly now as the economies reopen fully. We have also booked increased costs with our new digital projects as we upgrade most of the systems and the processes which support all our core activities. Ebitda for industrial and energy management was down year on year to only 65 million. And here we have refining, which had its throughput limited by planned maintenance, such as in the hydrocracker during Q4, and unplanned stoppage in the atmospheric distillation unit. Now these have significantly limited the utilization and the margins that we have managed to capture during the last quarter. And energy management was impacted by the high regasification costs during the first 3 quarters and by gas sourcing restrictions, especially during the second half of the year. Now, although some mitigating measures were implemented, still we had to buy from the spot market at inflated prices to make good on our commitments with clients. Now these 2 non-recurrent effects impacted our Ebitda by around 180 million in 2021, of which 80 million in Q4 alone. Now these are not structural impacts. Our refinery is now operating normally and we are mitigating further gas sourcing restrictions. On renewables, our assets under operation are not consolidated. So here we use a pro-forma Ebitda to highlight the performance of this business. So pro-forma Ebitda was robust in the year, given the high wholesale power prices. Now, bottom line for the full year, net income was 457 million. In Q4, it was 130 million, also reflecting increased upstream taxation. On cash flow, operating cash flow was up about 50% year on year to about 1.9 billion. And OCF is the metric we should focus on, because CFFO includes volatile, special items, inventory effects, and working capital movements. And this was only about 1 billion, reflecting a very material working capital build of 1.2 billion in the year. Of this, about half, so 600 million of this build, is related with increased margin accounts related to our hedging positions to lock in the TTF Brent spread on our gas positions. And as we've discussed before, this build in margin collaterals is temporary and is reverting as the 2022 TTF prices correct downwards and as we deliver the gas to our clients throughout the year. Working capital was also up from the higher commodity price environment, but also from the refinery restrictions during Q4, as we had to acquire oil products which have shorter payment cycles to make up for the lower refinery runs. Net capex, 500 million during the year, was at the bottom of the range of our guidance. And this includes the proceeds, of course, of the GGND sale and the sale of the P71 FPSO to Petrobras. And within capex, we have the final payment of 73 million related with Galp's increased stake in Bacalhau, and this payment became due with the unitization of the two areas at year-end. So excluding this 600 million increase in margin accounts, free cash flow would have been 1 billion, and net debt to Ebitda would have been 0.8 times. And that's how the board is looking at this when it proposes the 2021 distributions to the upcoming AGM. So in addition to the base dividend, there will be a proposal for additional distributions, now this time through share buybacks. Now looking into 2022. So our investment plan remains unchanged. So with net capex still expected within 800 to 1 billion euros on average per year during the 21-25 periods. This net capex will allow us to progressively reshape our portfolio towards our lower carbon ambitions. In relation to 2022 itself, net capex could be closer to 1 billion as we reach peak capex in Bacalhau and increase the pace of our renewable developments. Our current asset base is very well positioned to capture the current healthy macro environment, which we expect to hold for the rest of the year. So we are considering a Brent price of $75 per barrel, a realized refining margin between $4 and $5 per barrel, and a solar capture price of 150 euros per megawatt hour. On this basis, consolidated group Ebitda for 2022 is estimated at around 2.7 billion. This is mostly driven by the strong contribution from upstream. Group OCF, operating cash flow, the key metric for our distributions, is expected at around 2 billion euros. And this already considers a higher mix of upstream in our overall taxation. Commercial contribution should be in line with 2021. Now we see volumes going up, but some margin pressures. And going forward, we will be booking under the commercial division the two new platforms, Galp Solar and Flow, which are migrating from our new businesses division. And for now, these two businesses still bring a negative contribution, but with scale, they should gradually reach break-even. On the industrial side, refining has no relevant maintenance activities planned for this year. And energy management should correct upwards, as we now have normalized regasification costs and have worked with our suppliers to mitigate gas sourcing restrictions. On renewables, we expect a pro forma Ebitda between 180 to 200 million, given the increased capacity online and the healthy wholesale prices. Now, to wrap up 2022 guidance, operating cash flow, together with the reversion of the 2021 working capital of 600 million, this should lead to significant free cash flow and very significant deleverage. We have, therefore, fine-tuned our distribution guidelines. So now we incorporate a 4% dividend per share increase every year. In addition, there will be share buybacks when net debt to EBITDA is below 1 time, and the maximum amount we will distribute is 1/3 of operating cash flow, not CFFO, 1/3 of operating cash flow. So we do expect to end 2022 with net debt to EBITDA well below 1 times. So in relation to the 2021 fiscal year, the proposal to the AGM will be 50 cents per share in cash. We have already paid half as an interim dividend of 25 cents last September and plan to pay the remaining 25 cents after this upcoming AGM. And there will be a proposal for 150 million euros in share buybacks planned to start after the AGM approval and with execution throughout the year. Related to the 2022 fiscal year, the cash dividend should be 52 cents, so a 4% increase year on year, with the first 26 cents paid in September this year and the final 26 cents after the AGM next year. And regarding the buyback program in relation to the 2022 fiscal year, it will be executed throughout 2023. And this should be the new normal going forward. Thank you.